Thank you for joining us today for our webcast on accounting methods for contractors. I'm Jeff Rogers, and I'm a tax partner at Feeley Driscoll, a Boston-based regional accounting firm. Our construction group specializes in providing tax and business consulting services to contractors across New England. Today's discussion is going to be on accounting methods available to contractors. And if you have any questions following the webcast, please call at 888-875-9770 or visit us on the web at www.fdcpa.com. When it comes to identifying their overall method of accounting, as with most other businesses, a contractor is able to use the cash or accrual methods unless another area of the code prohibits it. Two common restrictions that we see. C corporations with more than $5 million in gross receipts on average over the previous 3 years may not use the cash method. In addition, you may not be able to use the cash method if you have significant inventory. A contractor that uses the cash method of accounting reports revenue when receipts are collected or constructively received, and deducts expenses only when paid. Constructive receipt, by the way, occurs when you have unrestricted access to the income that you have earned. The cash method affords you the ability to plan for tax purposes, whether it be delaying the release of an invoice or immediately paying a bill before the close of the tax year. With proper planning, you can drive down your tax liability from year to year. Under the accrual method of accounting, income is included in the year in which all the events have occurred that fix the right to receive the income, and the amount of the income can be determined with reasonable accuracy. Expensing under the accrual method typically works the same way, in that a deduction may not be taken until all the events have occurred that establish the liability, the amount of the liability can be determined with reasonable accuracy, and economic performance has occurred. At this point, it's worth noting that, for many construction contractors, the overall method of accounting that they have selected is really only the method they will be using for their short-term contracts. That is, contracts that are both entered into and completed during the same tax year. That's because the Internal Revenue Code has a section, 460, that is entirely devoted to the treatment of long-term contracts. The general premise is that a long-term contract, one that spans 2 tax periods, even if very short in duration, must use the percentage of completion method. The percentage of completion method, in the IRS's view, is the most accurate representation of a contractor's income from year to year. Under the percentage of completion method, the contractor estimates the total cost that they expect to incur over the life of the contract and determines the income to recognize by deriving a percentage of the costs incurred to date over those total estimated costs. That percentage is then multiplied by the total contract price to determine reportable revenue. So why, if the income recognition is driven off of an estimate, is this the IRS's preferred method of accounting for long-term contracts? The answer lies in the requirement that the percentage of completion method be paired with the look-back method. It's pretty simple. Once the contract is complete, the final total costs are tabulated, and the gross profit is known, the contractor is required to look back to the prior year or years to determine how much they would have reported in revenue had they known back then what the final cost amount would wind up being. If income wound up being understated in those prior years, the contractor owes the IRS interest and will pay it to the IRS with their tax filing as an additional tax. Similarly, if income was overstated in those years, the IRS will actually pay interest, so it does work both ways. Not all long-term contracts need to be evaluated for look-back purposes. Only those contracts with revenues exceeding 1% of the prior 3 years' average gross receipts need to be considered. Further, once look-back has been calculated, if the result shows that the income or loss reported each year came within 10% of the income or loss that should have been reported, you can make an election to exclude the job from the calculation. Now that we have identified why the IRS is in favor of the percentage of completion method and how it's calculated, let's review who is required to use the method and whether there are any exceptions. First, we need to consider whether a contract will even be considered a long-term contract. Just because a contract spans 2 tax periods, it is not automatically subject to IRC 460. The definition of a long-term contract provided in IRC 460 F1 is that of a contract for the manufacture, building, installation, or construction of property if the contract is not completed within the taxable year in which it began. Taking it a step further, a construction contract is defined as one for the building, construction, reconstruction, or rehabilitation of or the installation of any integral component to or improvements of real property. If the services performed do not meet the definitions, the contract would likely not be considered a long-term contract that is required to use the percentage of completion method. So let's just assume that the work does meet the definition of a long-term contract. There are a few additional exceptions worth noting. A home construction contract is not required to be reported on the percentage of completion method. A home construction contract is a contract where 80% or more of the estimated total contract costs are attributable to the building, construction, reconstruction, or rehab of buildings containing 4 or fewer dwelling units, and improvements to real property that directly relate to those dwelling units. Rather than the percentage of completion method, the contractor may use an exempt contract method of accounting. More on this in a minute. Another type of contract with an exception is a residential contract. A residential contract has the same definition as a home construction contract, except that the work would be performed on a building with more than 4 dwelling units. A contractor may use the percentage of completion capitalized cost method, which essentially allows for 70% of the job to be reported on the percentage of completion method and 30% of the contract under the previously mentioned exempt contract method. The last exception that comes into play is the small contractor exception. A contractor with average gross receipts of less than $10 million is allowed to use an exempt contract method on any long-term contract estimated to be completed within 2 years of commencement. So what is an exempt contract method of accounting? Well, for simplicity, it could be the method that you identify as your overall accounting method, such as cash or accrual. Another very common exempt contract method of accounting is the completed contract method. With the completed contract method, the contractor does not have to recognize gross profit on a long-term contract until the job is complete. In the case of a residential contract, 30% of the gross profit may be deferred until completion. The regulations stipulate that a job should be treated as complete for tax purposes when the job is 95% complete and being used by its intended purpose, or upon final completion exception of the subject matter, whichever comes first. Of all the methods of accounting available, the completed contract generally provides for the greatest deferral of income. Not surprisingly, the IRS is not a huge fan of it and restricts its use to small contractors, home construction contracts, and 30% of residential contracts. Let's suppose that you are a large contractor that does not do any home or construction work. Is there any opportunity for deferral? Yes, there actually is. First, going back to the beginning, if the cash method is your overall method of accounting, the fact that you are a large contractor does not preclude you from continuing to use the cash method on short-term contracts. Another technique available to general contractors would be to change the manner in which the percentage of completion method is calculated by excluding retainage payable to subcontractors as a cost incurred until the point in which the liability becomes fixed and determinable. For this to work, contracts with subcontractors should be written to stipulate that retainage is not payable until full acceptance and completion of the project. Another deferral option is an election to defer the gross profit on jobs that are less than 10% complete at the end of the year. This election is made with the tax return and can be made by any contractor, regardless of the size. One point that I would be remiss if I didn't address is the impact of the alternative minimum tax. Throughout this webcast, I have spoken about different methods that might be available for reporting long-term contracts. Generally, any deferral of income related to a long-term contract is a deferral for regular tax purposes only. For AMT purposes, all long-term contracts, emphasis on long-term contracts, must be reported under the percentage of completion method. There are some exceptions to this rule, long-term home construction contracts being one, but generally an AMT adjustment is required. Needless to say, the AMT is an area that must be considered during planning to avoid any unwanted surprises. That leaves really one last question. How do you select your method of accounting? It's pretty straightforward in the year that you start up operations. You simply adopt the methods that you wish to use and file your tax return consistent with the approach. No disclosure or statements necessary, just check the appropriate method of accounting box on the tax return. It's when you get beyond year one and you wish to change your method of accounting that it can get complicated, as you must file a change in accounting method application, Form 3115. You must be aware that certain method changes require advance consent from the IRS in addition to a filing fee, while others are considered automatic changes that can be made at the time of the tax return filing for the year of the change by attaching a 3115 to the tax return. No user fee is required for automatic changes. An overall change from the cash to accrual method of accounting will typically be considered an overall change. Rev Proc 2011-14 contains the procedures for obtaining automatic consent. Rev Proc 97-27, which has been modified several times over the years, provides the general procedures for obtaining advance consent. There will be some calculations required, notably what's referred to as a Section 481 adjustment, which is needed to prevent amounts from being duplicated or omitted between one year and the next when an accounting method change is implemented. Section 481A allows a net positive adjustment to be brought into income over a 4-year period. To put that into some context, if a contractor wishes to change their overall method of accounting from cash to accrual and had a $10,000 cash basis deferral at the time of the change, the deferral will be brought into income in 4 equal installments of $25,000. Conversely, a net negative adjustment will be deducted immediately. In addition, typically when a method change is made for long-term contracts, the cutoff method will apply. Basically what this means is that the new method goes into effect for contracts entered into during the year of the change, and all carryover contracts will remain on their previous method until completion. This same cutoff approach is taken when a small contractor becomes a large contractor by averaging more than $10 million in gross receipts over the prior 3 years, and the requirement to report long-term contracts on the percentage of completion method kicks in. No 3115 is required. With that, we're going to conclude our discussion on accounting methods for contractors. There's a lot more that can be covered, and changing methods can lead to complexity. Fortunately, Feeley Driscoll's construction specialists are very well versed in all matters related to accounting methods and have prepared and filed many applications for changing method. If you have any questions that you would like addressed, please feel free to give us a call at 888-875-9770 or visit us on the web at www.fdcpa.com. Thank you for joining us.